Hi. To start with, I should talk about a serious thing. Food was very good. This means next year attendees from Italy will thrive. Well, the connection has been growing through the years. It's a matter of how the investment process is changing and the interaction is growing a lot. I mean, there's contamination between investment teams and risk teams, risk performance teams that are getting closer and closer together when they get through focusing on the performance. Well, we strongly believe that unless there's a well-built feedback loop, the process wouldn't work very effectively. So we designed an investment process where these feedback loops continuously happen. And this means at various levels, daily, between PMs and portfolio risk officers, and then on a weekly basis between PMs or head of investment areas, together with specialists within portfolio risk officer that they review all the portfolios, and then finally at the investment committee. During these sessions, they sit down, they discuss critical points on preset thresholds, and investment side commit to mitigating action that then is controlled. This is feedback loop back from risk and performance teams. The key benefit is that people focus then on the purpose and not simply on the numbers, not simply on the taste, not simply on discussing the process whatsoever. They focus on the purpose. They start talking the same language, and both teams are actually going towards the same goal. And they're leveraging their both expertise and exchanging their both expertise. So this is really a good example of synergy, which eventually produce definitely an impact on portfolios. I would say that on average, we are still in a process of getting risk and performance teams, risk managers, closer to portfolio managers. We are not on an industry-wide up to that situation, so this trend will continue. Because those that did that have a competitive advantage, so the remaining one will follow. But then going forward, they will be focusing more on different approaches on portfolio management. Because what is going to happen in the coming years, this is a multi-year perspective, is that all models, all approaches, absolutely quant-based, will leave ground to more behavioral approaches. The industry is going to is acknowledging that is making such a big impact, such a huge impact on performances, which actually is not captured by quant models of traditional theories. Technology actually removes the operational part. Technology allows a seamless interaction between the teams. So in the past, creating and actually having the good numbers was the main target and was very often a point of discussion between the teams, whether this number was correct or not. Technology has improved a lot, so is giving you sounder processes, sounder figures, so teams actually can focus on the content, can focus on the purpose, as I said before, and not on creating numbers, which was actually a strong bias for risk managers, making sure the numbers were correct, because they feared the discussion with PMs. They were claiming maybe, I don't have this number, I have another one, that's not correct, and so on. That the technology actually is smoothing out this relationship on that side. Well, I would say that events like this actually have an accretive value added for all the industry, because every time come, every time I come in, actually I meet colleagues of mine that have experimented new ways to approach their daily business, and they're open to share that. And so it's a very useful brainstorming, and eventually the whole industry is getting off better.